What systemic risks come from shadow banking? Imagine a financial world where activities happen outside the usual banking rules, yet still involve borrowing and lending. That's what shadow banking is all about. It includes non-bank financial entities that do credit and maturity transformation without being traditional banks. These activities carry risks similar to regular banks, like the chance that borrowers won't pay back loans or that short-term funding might suddenly dry up. But because shadow banks often lack enough internal capital buffers, they rely heavily on external support, which can be private or from the government. When risks are transformed without enough buffers, problems can spill over into the entire financial system. If a shadow bank faces trouble, it might not be able to cover losses, and that can cause panic. These entities are often linked to regular banks and other financial institutions, creating complex webs of connections. When one part struggles, it can quickly spread to others, causing widespread issues. A big danger is the mismatch between short-term borrowing and long-term assets. Shadow banks often borrow money for a short period to fund assets that take longer to pay off. If investors suddenly withdraw their money or refuse to roll over loans, it can trigger a run. This happened during the financial crisis of 2007-2008, when fears about subprime mortgages caused investors to pull out, leading to a chain reaction of failures and market illiquidity. Another risk is that shadow banking can make financial cycles more extreme. When times are good, shadow banks expand credit rapidly, increasing leverage and risk. But when the economy slows down, they can pull back sharply, worsening downturns. This procyclical behavior can make financial crises worse. Because shadow banking activities often happen outside the scope of regulation, it's harder for authorities to see and control these risks. The opacity means that, during times of stress, uncertainty and panic can grow quickly. Many shadow banks depend on support from larger, regulated banks or governments. While this support can prevent immediate collapse, it also encourages risky behavior, knowing they might be saved if things go wrong. This moral hazard can lead to even bigger risks being taken. Looking back at history, the 2007-2008 crisis was partly caused by problems in shadow banking. When investors lost confidence in mortgage-backed securities, funding dried up fast. The panic spread, causing many institutions to fail or need government help. This showed how interconnected and fragile the shadow banking system can be. Throughout financial history, shadow banking has been a way to innovate and expand credit beyond traditional banks. But it also introduces new vulnerabilities. Regulators now focus on making these activities more transparent, controlling leverage, and limiting implicit guarantees. These steps help reduce the chances of another crisis. To manage these risks, authorities are working on better oversight of shadow banking, requiring more transparency, and limiting the support that can encourage excessive risk-taking. They also aim to use macroprudential policies to prevent dangerous credit booms and busts. Understanding these risks helps us see why shadow banking, despite its benefits, needs careful management to keep the entire financial system stable.